everyone. Welcome to Tax Chats. My name is Scott Dyring. I'm a professor at Duke University, and I'm joined today again by my colleague and friend and tax genius, Jeff Hoops at the University of North Carolina. Jeff, say hello.
Hello.
He's got all his UNC gear on for a special purpose, I think, today. So what we're going to do today, Jeff's going to kick us off, and then I will chime in as necessary. So Jeff, take it away.
Yeah, so we actually were talking about our topic of discussion was the taxation of wealth here in the United States, and we decided that Scott could not present an unbiased view of this because he comes from a very wealthy family of turkey farmers, and with all that turkey wealth, he just can't opine on the subject unbiasedly. So I have to, from my humble Idahoan roots, I'm here to talk about it.
So we need the potato farmer to talk about it because the turkey farmer couldn't quite.
So I come from Idaho, but do not farm turkeys. You really did legitimately farm turkeys. This isn't made up.
Legitimately farm turkeys. That is that is true.
Yeah.
I can say I did not get wealthy.
I mean, you're pretty wealthy. Okay. So what we're talking about today, the email said we're talking about wealth taxes, and what we're talking about is a form of wealth tax. It's a little bit different than wealth tax. So just to set the stage, where we're at kind of in tax policy is the Democrats really, really, really want to pass a spending bill. They have all these different priorities they want to do, but they cost a lot of money. Right? So this is varied in price from 3.2 trillion or 3.5 trillion. Now we're at about 1.5 trillion, which it seems like, just barely anything, 1.5 trillion because it's down so far. But again, that would be one of the largest bills we've ever passed in the history of the United States. So where to get 1.5 trillion? Democrats have talked about increasing corporate taxes. They've talked about increasing individual taxes. They've talked about increasing the capital gains tax rate. The problem is there's only 50 Democrats. You have to get all 50 Democrats on board. And there's 2 Democrats that are not quite on board with all these plans, right? So we have a senator from West Virginia and a senator from Arizona, both of whom basically are unwilling to increase the corporate tax rate, increase the capital gains tax rate. So Democrats are looking for other ways to increase taxes. So not only that, but within the Democratic Party, there's this huge kind of idea that, we're going to raise taxes on somebody. Who should we raise taxes on? And of course, the answer is, Scott, who should we raise taxes on?
Jeff Bezos.
Jeff Bezos, and even more generally, not just Jeff Bezos, but we want to tax the rich. This is what the Democrats are all about, is taxing the rich folks because, well, they got the money.
Hang on, I thought we were going to tax the rich and especially Jeff Bezos.
We're going to tax Jeff Bezos. Poor Jeff. I feel an affinity to Jeff because my name's Jeff. But we want to tax the rich. So the problem is why aren't the rich paying very much in taxes right now? Well, it depends on how you think about it, actually. So if you look at the fraction of total taxes paid, the rich pay a crazy lot of the total taxes paid. That would be the side of this story that the Republicans tell. If you're telling the Democratic version of this story, though, you're going to say, well, the rich pay a very small fraction of their total wealth or income in taxes, depending on how you account for income. And that turns out to be a super, super important point, right? So, for example, you have Jeff Bezos, and he doesn't pay, relative to how much one might think he should pay in taxes, doesn't pay much in taxes. Why is that? Well, imagine I'm Jeff Bezos, and just to facilitate your imagining that I'm Jeff Bezos, I have my Jeff Bezos wig. So if I'm Jeff Bezos, what did I do? Back in the late 90s, I have this brilliant idea that I'm going to sell books. I was going to sell books. It's just fascinating to think that this was the brilliant plan that made me so wealthy. I'm going to sell books, and I'm going to sell them on the internet. And back in the late 90s, they put the internet on computers so that I could sell books on the computer. So I start selling books on computer, start Amazon.com, and it grows. We start selling other things in books. We start providing cloud computing, and we're just this explosion of stuff that gets sold and services that get generated on Amazon. And because of that explosion, I become very, 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 very rich. So I start out with a company that's worth $0. Now I own a small fraction of that company, but the piece that I own is worth about $200 billion. So I've gone from 0 in wealth to $200 billion in wealth, but how much of that increase got taxed? Well, 0. And if you're part of the tax the rich crowd, then that really kind of upsets you, right? Because you like see Jeff Bezos, currently the second most wealthy person on earth. He would be the most wealthy, but he got divorced. Second most wealthy person on earth. And he's not paying that much in tax as far as like explicit taxes that he pays himself. So why is that? Well, because in the United States, as everywhere else in the world, we believe in what's called the principle of realization, which means that if I, Jeff Bezos, don't sell my stock, I don't have to pay taxes on it, right? So I started with zero, I have 200 billion. That difference is untaxed as long as I don't ever sell. And that's a really, really, really big deal. Okay, so Democrats that, again, need some way to come up with $1.5 trillion are thinking, okay, how can I tax, or how can we tax that that $200 billion? So there's a couple different options. So first of all, you might think, well, I mean, if we're talking about stock, why not just increase the capital gains tax rate? And they've talked about that. Again, Kirsten Sinema from Arizona, senator from Arizona, doesn't want to do that. So it's unlikely to happen. But the problem with just increasing the capital gains tax rate is, number one, again, it doesn't help at all if I don't sell, if Jeff Bezos doesn't sell. And the second problem is, of course, if you increase the capital gains tax rate too much, you might actually end up generating less in income. We'll likely talk about that later. That's actually kind of a super interesting point. But so there are principle of realizations in the problem. So you have to basically find some way to destroy the principle of realization, or to get around the principle of realization. So back when Bernie Sanders and Elizabeth Warren were running for president, they both proposed plans are pretty similar, just like some details were different, but pretty similar, that would have gotten around this problem, that were wealth taxes. There's basically just take all the stuff that rich people own. So if I'm Jeff Bezos, everything that I own, which is basically just Amazon stock, and apply some tax to it. So you have like some threshold, and you, above that threshold, tax everybody at some rate, right? But what we are talking about now is not specifically that. Instead, what they want to do, and I'm going to stop being Jeff Bezos because the wig gives me a headache. I imagine being Jeff Bezos in general gives people a headache, but I have a very fat head. It just like sucks on my brain and it gives me a headache. So what they want to do is not just tax wealth every year and that's it, but the current plan that's being evaluated by the Senate and the House that's being floated is a one-time wealth tax where they'll tax all liquid wealth, which is different than all wealth. So they'll tax things like stocks and bonds and even cash. And then on an ongoing basis, every change in wealth, they will tax.
So Jeff, I think we should talk a little bit about just how big of a deal that would be for somebody like Jeff Bezos. So
yeah, how big of a deal would that be for Jeff Bezos? I'll put this on lightly so as not to give him
okay, so if
you were the Jeff Bezos.
If you're Jeff Bezos and you take the price of Amazon today, which is something like $33.50 per share, $3,350 per share. And he owns like 55 million shares. So he's got a lot of
200 billion dollars.
200 billion. So tax that at 37%. His entry tax would be like 68 billion.
Yeah, so that 37% is the individual income tax rate.
Yeah. So
and he just wants the entry tax just one time, all in one go. It's a lot of money.
So he'd have to pay 68 billion. Now the last thing I read said they would be kind to people like Jeff Bezos and allow them to make that payment over the course of 5 years. So
it's like an installment plan. Like when I buy things on Walmart and I have to buy the $30 thing on installments over the course of years, they're very kind.
He would get an installment plan. So he would have to pay something like $13 billion a year for the next 5 years. And then every year on top of that, so just if we were to take this year so far from January until today, Amazon's stock has increased by $80 a share. So that's an increase for him of about $4.4 billion. So his tax this year would be $1.6 billion on top of the entry tax that he would be paying, $13 billion a year. So he'd be paying a lot of taxes. It'd be a big tax bill for Jeff Bezos. How would he actually pay that, Jeff? How would he come up with would he have to sell all his stock to come up with the cash?
Yeah, so I think this is there's a lot of different things to go through, and this is an important one in that we think of Jeff Bezos as super wealthy, but actual cash, I'm sure he's got tens of millions, if not hundreds of millions in cash, but he doesn't have tens of billions in cash. He has tens of billions in stock. So to fund this, he would have to sell some Amazon stock, which means not only does he not have that wealth, but he also doesn't have that control, right? So it's the government mandating that a company that you've started, that you're no longer able to control that company, and somebody else will control it. And that's, you could think of that as good or bad, but it is a definite outcome that to fund this, people, especially the founders of large corporations, are going to have to give up some of the control of their corporation.
So that's been one of the complaints about a more traditional wealth tax, where a tax is imposed on kind of any kind of wealth, not just like liquid wealth. And one of the complaints is something like this: a farmer who inherits a very valuable farm that's been in the family for many years would have to sell the farm to pay the taxes because they don't have enough cash. Many farmers are sort of land rich and cash poor. And that could result in a situation where it's like the government ends up owning all the farms, or people who don't farm end up owning all the farms, or something weird like that.
I mean, that's theoretically true. What they've done with the thresholds is basically to eliminate any farmer. I think the farmer thing is actually pretty fascinating in that, Democrats obviously want to tax the rich. I'm wearing the shirt, tax the rich. And so what do the rich people do? Well, they have to conjure up the most scary stories possible to make it so that the poor people will fight the rich people's battles. And one of these, I think, is somehow dragging farmers into the mix.
Well, but so I think
at the Warren Sanders thresholds, there are not many small farmers at all in that mix.
Yeah. So would you agree that one of the purposes of making the threshold super high and restricting the tax to something like only liquid assets is to combat the common narrative that the poor farmers will go out of business or something like that?
Well, it's not only to combat the common narrative, but it's just to make it administratively easier, right? So especially the liquid assets, one of the biggest problems with the wealth tax is just knowing how much wealth people have, because if it's not in liquid form, it's really hard to know how much stuff is worth, right? If you have land or real estate or art, it's really hard to value those things. So you get over that problem just administratively by only taxing liquid things, of course, causing the other problem that now everybody wants to own non-liquid things.
Yeah, so if we look behind Jeff at the UNC Tax Museum, he has a bunch of things in his museum that might have value, but it'd be really hard to determine what the value of those things are, right? We don't know.
And basically infinity, but for tax purposes, zero.
For tax purposes, of course, Jeff would argue they're worth nothing. But they might be worth a lot, and it'd be really, really hard to figure that out because they're unique items and so forth. But with stock that's traded every day, you can figure that out easily. So doesn't this create a lot of weird incentives for people who might own stock?
Yeah, I mean, somebody just mentioned in the chat, you just said for stock that's traded publicly, it's easy to value, so therefore easy to tax. Well, if I'm thinking about IPOing with my company, and if I can, depending on how they write the legislation, if I can IPO and be subject to this tax, or not IPO and not be subject to this tax, well, that could be a lot of money difference, and you might just not go public, which is interesting. You might think, well, what's the cost to society if fewer companies going public? It depends on how you think about it. But one way to think about it is that small businesses or small companies that go public are often growing very, very quickly and generate a lot of wealth for people who are allowed to own those stocks.
Which, by the way, is
public.
We all own those stocks at some level, right?
Because we all own those stocks, yeah. Well, we all own those stocks if they're public. So the point is anybody can own a stock if it's public. I just sign into my Fidelity account, and if I have $50 or my Robinhood account, if I have $1, I can buy those stocks. If they're privately held, only the very wealthy have access to those markets. Like Robinhood, you can't buy shares in most private corporations on Robinhood. So restricting the new up and coming companies from public equity also limits the ability of lower income people to access that wealth generation, which I think is a kind of a perverse consequence of taxing IPOs.
Okay, so I have a couple questions for you. One is, let's suppose that the objective of the Democrats is twofold. One is to raise revenue, but there's many ways that could be done. And the other is this objective, which we've talked about before, which is sort of redistribution of wealth and taxing the rich and making the world a more equitable place. And it's difficult to tax some very, very wealthy people because all of their income is in capital gains in large publicly traded companies. So this proposal would be one mechanism of getting at that income and wealth. Are there other ways that one might think about imposing a tax to tax that same income or wealth, depending on how you want to look at it? So, for example, there is currently on the books an excess accumulated profits tax, the accumulated E&P tax, which basically says if a company, retains too much earnings, the company has to pay tax. And now, as far as I know, that's is never enforced or imposed. But could something like that be designed, which would, instead of taxing Jeff Bezos directly, just more heavily tax the company that he owns? Would that be possible?
So certainly you could think of a variety of corporate level taxes that would do it. I mean, I think that the Democrats would say their additional proposal, which is taxing book income at a minimum of 15%, gets at the same thing, right? So what you're saying is you can tax Jeff Bezos, or you could just tax Amazon, which would make it so his share price doesn't go up quite as fast and is some way to get taxes out of Jeff Bezos. And so there's a lot of things you could do to tax Amazon from that taxing book income. But also, just get more directly at the person. I think and this is where I thought you were going to go. I think the simplest thing is to get rid of the step up in basis, right? So if everybody remembers, when people die, if Jeff Bezos dies with his $200 billion intact, the estate tax is going to have some of that, depending on how much planning he does. But as far as individual income tax, all $200 billion is going to go untaxed. He'll pass it on to somebody, and there'll be no capital gains tax passed on that at all under our current tax system. Why we have that? It's kind of just a mistake of history. And we could get rid of that, and it would end up taxing a lot more, either taxing a lot more of that would be taxed, or a lot more of that would be given away, which, depending on who you ask, might be preferable to giving it to the government.
So speaking of giving it away, do you think that people like Jeff Bezos will begin to do what many wealthy people do, which is create their own foundation, like the Bill and Melinda Gates Foundation, and just donate all of their wealth to their own foundation so that it can escape taxation and still remain in their control?
Yeah, I think that's a pretty common thing to do. How much of it's actually in their control? For every $1 billion that Bill Gates used to have in his own checking account, how much is that worth in the Bill and Melinda Gates Foundation? I don't know the answer to that. But there's a little bit of a trade-off. But certainly that is a strategy a lot of people are doing, and I would expect Bezos to have already done and do even more. And again, I don't know what the downside to that is if the Bill and Melinda Gates Foundation isn't actually doing good with those assets. But I think in that case they are. There are other foundations that I think aren't, but depends on whether you think they're actually really giving it away or not.
So you're saying it's probably not a super major drain on the economy if the income gets shifted to some foundation or something along those lines.
Depends on the foundation. Some of these foundations are clearly scams, and the rich people
so in other words,
all of their relatives. It is a drain. If you're actually setting up a foundation that does good, then no. Well, then it becomes very philosophical. Do we want Bill and Melinda Gates and the smart people that they hire to solve the world's problems, or do we want the government to solve the world's problems? And that becomes a philosophical question.
Yeah, so that's an interesting thing to think about. So someone in the chat has asked about the windfall profits tax in the 70s, which I was 3 years old in the 70s, so I don't remember that very well. I know that there have been windfall profits tax of various forms throughout history for various reasons. And that's sort of getting along kind of to the alternative way of taxing wealthy people. You say, well, you got too much profit, let's just tax that profit at a higher rate. But the problem is, if you have a company like Amazon, Amazon's stock market valuation is enormous compared to the profits that Amazon has generated. And that's because Amazon, I think investors think Amazon has this great future where it's going to just become a massive cash cow. And in fact, it is becoming a massive cash cow. But you might remember it was only 2 years ago where Amazon reported 11 billion in income and paid no tax at all, no corporate tax, because basically they gave away $11 billion worth of restricted stock, which reduced their tax bill to zero. And I don't think that can continue indefinitely, but it does make it a little tricky in some circumstances to tax corporate income, because there's lots of things that can make that difficult to do.
I mean, this is especially the case for like up and coming companies. Like, I mean, Tesla, if you tax the income of Tesla, I don't think Tesla's producing very much income at all.
And in
But
fact, Jeff, by the way,
enormous, I mean, Elon Musk is.
I just have to say this because it's amazing. Almost all of Tesla's income comes from tax credits.
Yeah. I mean, Elon Musk is the world's wealthiest person, not because the cash that Tesla has already generated, but because the cash that the stock market anticipates it generating in the future, which from a tax perspective are two very, very different things. If you think about like taxing Elon through Tesla.
Well, it's also interesting because what you're really doing with this billionaires capital gains tax that we're talking about today, you are really taxing the expectation of income, not actual income. It's unrealized. Nothing has happened. The stock market just thinks it's all going to happen. They've bid up the stock price because they think there will be income in the future. And the government wants to tax that, which is, it totally could do. It's just an interesting philosophical thing because traditionally the government taxes income when it's realized, when it's actually, happened, not the expectation that income might happen or something like
when
that.
When you say happened, I mean, I get the vibe that like you don't think Jeff Bezos actually has $200 billion in assets. So happen, it's like a fairly philosophical thing, whether this stock has been sold or not. He has assets worth that much. It's just that those are predicated upon what happens in the future.
Yeah.
And one thing I think is very important about this all is like we've talked about, Jeff Bezos starts from zero, he's at 200 billion. The market can come down, which is something that I think is super interesting in these plans. That you have to think about that, right? So if Jeff Bezos starts from zero, he's at 200. Let's say he pays the one-time tax, 37% on this 200 billion. Well, what happens if the value comes down? You might do different things with that. So they actually came out with the legislative language for this very, very, very recently, and I haven't had time to get through all of it. But in other times when they talked about taxing unrealized capital gains, and sometimes they'll actually give people a refund for losses when the stock market comes down, which would be pretty fascinating, right? So imagine we have our next financial crisis, like it'll happen at some point, and Jeff Bezos now is worth 150 instead of 200. So simultaneously, with like the stock market crashing and everybody's unemployed, and we're trying to come up with like stimulus packages to hand out more checks to people, the U.S. government's going to cut a check to Jeff Bezos for like tens of billions of dollars to refund his the tax.
That would really be quite the political circus, right? By the way, this sort of thing has happened before. So in the .com bubble, there were tons of people who were receiving stock options, and those options would vest, and the employees would exercise the options, but then they wouldn't necessarily sell the stock. So they would owe these very large tax bills based on the gains that they had upon exercise. But then when the bubble burst, suddenly the shares became worthless. So when they went to liquidate the shares to cover the tax bill, there wasn't enough cash to pay the tax bill, which was like a huge problem. Like people went bankrupt because they couldn't pay the tax bills because it was tax on something was unrealized.
Yeah.
It's pretty interesting to think about. Somebody in the chat asked a question, which I'm going to pose to Jeff, which is, if your objective, Mr. Tax the Rich t-shirt wearing man, were to tax the rich, that was your objective, to get at the uber rich, how would you do it?
So that's a good question. I mean, I think the question is like, how constrained do you want to be? I mean, it makes me remember I was once walking home with a friend in Ann Arbor, and there were just like hundreds of crows in the sky. And I asked, if you wanted to kill as many crows in this city as possible, how would you do it? And I had in mind like what kind of gun he would use or whatever. And he said, I'd just drop a nuclear bomb on Ann Arbor and take out the whole city. Every crow would die. And it's just the question of like, how much collateral damage are you willing to create, right? So certainly this tax that we're talking about now would be a great way to do it, actually. There'd be a lot of collateral damage, and a thinking person is going to like weigh whether or not that collateral damage is worth it, but you'll get a lot of taxes out of it. Just an unmitigated wealth tax like Sanders and Warren would also get a lot of taxes out of the rich. I think an important question to ask is like, why do we want to tax the rich? Right. So one is because they got all the money and we need revenue. That seems like actually a reasonable thing to think about. The second is like, we really don't like rich people, and any pain we can inflict on them is useful. I think that is the motivation for some people, right? You have a voting bloc, and it just really is upset that there's so much income or wealth inequality, and taxing rich people get you points if you're a politician. I think another important part to bring up, though, is a lot of people, very, very, very validly so, fear the wealth that the rich have because it buys them political power, right? So if you're Jeff Bezos and you can literally just like with a fraction of your wealth buy the Washington Post and now own this media empire that you can maybe use to spread your message. I mean, the people at the Washington Post would say that they're completely independent, but who knows, right? So you have a lot of political power if you have all that wealth. Would taxing the rich in any way decrease that political power? I don't think so, actually. Like, if that's the intention, it wouldn't. Why is that? Because even if you say, well, Jeff Bezos, you now have, instead of 200 billion, you just have like a mere 2 billion. $2 billion is still an unfathomable amount of money.
It's not if you grew up on a turkey farm. I mean, if you grew up on
I guess for the turkey farmers amongst us, you'd have to have $4 or $5 billion to impress anybody. But
so here's another. It's
a lot of money, and so it's not only that it's a lot of money to just finish this thought. It's a lot of money, but also any taxing scheme's going to preserve the rank ordering. And in general, you have political power. Not only your absolute sum of money, which $2 billion would be a crazy amount, but also Jeff Bezos would still be second, and he'd still have like the second most money, and therefore the second most power if power is bought with money, and you're not taking that away from him.
So another argument that people often make with regard to wealth inequality is that if the wealth is in the hands of too few, that opportunities for the non-wealthy are restricted. And I think that argument has its basis in kind of historical situations where wealth was primarily concentrated in ownership of land. And if a few people owned all the land, and land was really one of the few ways to generate income at all, that had a lot of merit to it. Like, there's 5 people that own the entire land in the country, and everybody else is forced to be a peasant and work for those who own the land. The world has changed a lot in the last, several hundred years, but especially in the last 20 or 30 years, where wealth is often now created by intellectual development, intellectual property, which is not a finite resource. It can be expanded and expanded. And so just because Jeff Bezos came up with a good idea doesn't prevent Jeff Hoops from coming up with a good idea and creating more wealth. And that's an interesting thing to think about. I'm not really sure how much merit that has, but there is some argument to be made that taxing the wealthy for the purpose of redistribution of income and wealth has some merit to it. Makes sense at some level. The question, as you point out, is how much distortion are we willing to introduce into the economy to achieve those objectives? And that's a difficult philosophical question that is almost impossible to answer, perfectly ex ante. We sort of only see the results happen after the fact. All right, what else, Jeff? Have we covered it all?
I would add one point. I mean, you mentioned we only see the results happen after the fact. That's true. We can look to history, right? So we have not seen, as far as I know, a tax on unrealized capital gains like this elsewhere in the world, especially with people who have so much in unrealized capital gains. It's a very different situation to do this in some small country that doesn't have very many super rich people than to do it in the country like the wealthiest people on earth. So we haven't really seen this before, but we have seen a wealth tax, just a general wealth tax. And it generally has not gone very well. So there have been more than a dozen European countries that have had a wealth tax. Only a couple still have it. And a lot of them got rid of it just because it was hard to administer. People didn't like it. People were like leaving because of this wealth tax. And so like history suggests this hasn't worked that well. A, B, all of these countries that had it actually had almost all of them had lower rates than are currently being proposed in the United States. So with a less potent wealth tax, it was too burdensome, and these other countries got rid of it. So, the history of other countries is something to keep in mind. Now, certainly, if you ask the Sanders or Warren campaign, you told them that, they say, oh, yeah, we're completely aware of this. We've designed a different, better system. And maybe they have. We should look to history and see, like, what similar situations have we seen and how did that work out?
All right. Well, I think we're going to have opportunities to study this because it's looking more and more likely that it's going to happen. And when it happens, it will be fun to see what are the good and bad outcomes that result from something like this taking place.
It'll be fun for me, but you guys are going to have to give up all your turkey wealth.
The turkeys have been
cut the turkey baron down a few notches.
The turkeys have been eaten for Thanksgiving dinner, so I think we're good to go there. Okay, I just saw one last thing pop up here on the bottom. So actually, I think we should talk about this real briefly. If I know people might have to go, we said 30 minutes, but if you don't mind, I think it's worth looking at this, which is if Zuckerberg had to sell all his stock, or if Bezos had to sell all their stock to cover this tax, that could put significant downward pressure on the stock prices. The downward pressure on the stock prices then would sort of somehow reduce, I guess, the taxes that were owed, and almost like some kind of downward spiral. Is that like a legitimate problem, do you think, Jeff?
I'm not sure, right? I mean, if you just think about it the very, very standard, simple way that the price of a firm should be the sum of future discounted cash flows, the only reason those would change if Zuckerberg sells his shares is if you think like Zuckerberg is such a genius that his not being able to vote as much is going to cause problems for the company. So if there's no price signal in that sale, it might not change price. It might change price. I don't know. The invisible hand of the market and what it does to share prices is difficult to understand for me.
So it's something interesting to think about. I mean, this is there enough liquidity in the market to, deal with this kind of?
I think that's one of the reasons they allow you to pay over time. So you have several years to sell stock in little pieces.
Yeah. All right, very good. Thank you, everyone, for signing on. Thanks for great questions and a great discussion, and we'll look forward to chatting next week, most likely on a different platform, probably YouTube Live. So thank you again, and we'll talk to you next time.